December 22, 2025. While the world was distracted by holiday lights, a silent detonation rocked the global markets. Spot silver shredded every technical resistance like tissue paper, hitting a staggering all-time high of $69.53 per ounce. Why now? Why has the poor man's gold surged 130% in a single year, leaving gold's 60% gain in the dust? This isn't just a rally, it's the short squeeze of millennial proportions. While the masses chased volatile shitcoins, the smart money was quietly siphoning physical inventory out of COMEX and LBMA vaults, creating a lethal liquidity vacuum. The paper silver market is about to face a brutal reality. There is no physical metal left to back their leveraged bets. If you think $70 is the ceiling, you're misreading the tape. This is the death knell for the big shorts and a calculated trap for the arrogant. The spring is coiled. The trigger has been pulled. Welcome to the silver endgame.
Follow the trail of breadcrumbs into the dark heart of the global financial plumbing. My investigation reveals a three-pronged pincer movement designed by the smart money to crush the shorts and corner a market that is fundamentally broken. We are not just looking at a price rally, we are looking at the controlled demolition of the paper-silver illusion. 1. The debasement of the fiat shield. First, we must look at the Federal Reserve's systematic betrayal of the US dollar. Jerome Powell has effectively waved the white flag in the war against inflation by slashing the federal funds rate to the 3.5 to 3.75% corridor and stealthily reigniting the quantitative easing furnace. The Fed has signaled that the dollar is no longer a store of value, it is a depreciating liability. With the DXY dollar index bleeding out to a low of 98.6, the global elite are rotating their wealth out of digital promises and into the only conductor that matters. When fiat dies, Bach, silver, is the resurrection. 2. The industrial death trap, AI and the net zero facade. While the media distracts you with political theater, a structural supply-demand vortex is swallowing every available ounce of silver on the planet. This isn't just about jewelry, it's about the blood of the Fourth Industrial Revolution. 59% of global silver supply is now locked in industrial applications. Consider this. Each solar panel is a silver-hungry beast, consuming approximately 20 grams per unit. As the world blindly rushes toward the net zero mandate, they have inadvertently created a commodity trap. Couple this with the explosive growth of AI data centers and 5G infrastructure, both of which rely on silver's unparalleled conductivity, and you have a recipe for a structural deficit. We are currently entering the fifth consecutive year of a supply shortfall, with a cumulative deficit nearing 800 million ounces. The mines in Mexico and Peru are screaming for mercy, yet the world's appetite for AI and green energy is insatiable. 3. The ghost vaults of London and COMEX. The most damning evidence, however, lies in the vaults. My forensic analysis of the London Bullion Association reveals a chilling reality. Silver inventories have evaporated by 40% since 2022. We are seeing reports of institutional titans desperately chartering private cargo jets to airlift physical bullion across the Atlantic just to meet delivery obligations and avoid a technical default. In Shanghai, stocks have hit a 10-year nadir, and the COMEX registered inventory has plummeted to a mere 138 million ounces. The global buffer for industrial consumption has shrunk to a terrifying 30 to 45 days. The big banks have spent decades suppressing the price of silver through massive naked short positions on the COMEX, but you cannot print physical atoms. The iceberg orders are now surfacing. The whales are no longer buying paper, they are taking delivery. And when the vaults finally run dry, the big shorts won't just lose money, they will be incinerated. You are witnessing the greatest wealth transfer in history, hidden in plain sight.
Connect the dots. The naval skirmish in Venezuela isn't just news, it's an opening gambit in the Great Resource War. By neutralizing 30 vessels, the U.S. is performing a surgical amputation of resource liquidity. Along with the Israel-Iran shadow war, these are systemic shocks designed to shatter global supply chains. In high-stakes finance, instability is the ultimate alpha. When the map burns, silver becomes the ultimate safe haven buffer. But here is the secret. Unlike gold's ocean of liquidity, the silver market is a tiny pond, a mere rounding error compared to the $100 trillion bond market. Imagine a fire hose of scared capital fleeing bonds and trying to squeeze into a teacup. That is silver, a coiled spring of decade-long suppression meeting a geopolitical spark. Now, consider the net zero paradox. By mandating green energy, governments unwittingly signed an irrevocable contract to buy silver at any price. While central banks claim to fight inflation, their industrial policies for solar, EV, and AI drive silver demand into a structural supercycle. They have trapped themselves as involuntary buyers of last resort. They are desperate. They need silver for their green utopia in AI state, but atoms are scarce. Their failing strategy? Print more fiat to subsidize demand, devalue the currency, and inadvertently propel silver prices higher. This is a feedback loop of systemic failure. We don't trade the news, we trade the inevitability of the collapse. The establishment bets on their narrative, we bet on the laws of physics in the scarcity of atoms. The spring is no longer just coiled, it is fracturing the casing. Are you positioned for the release? Don't let $70 scare you. To an investigator, price is just a distraction. Value is what matters. In 1980, silver hit $50. Adjusted for 2025 inflation, that peak is actually $200 an ounce. We aren't in a bubble. We are just beginning to correct a decade of suppression. Unlike the Hunt Brothers game in 1980 or the QE2 spike in 2011, 2025 is the perfect storm. It is the convergence of a real physical deficit, the AI industrial revolution, and the terminal debasement of the dollar. You can't print physical atoms to fix this. The final warning, the margin trap. The establishment is fighting back. Exchanges in Shanghai and New York, COMEX, are already raising margin requirements. This is a margin trap, a calculated move to force retail traders using high leverage to panic sell. They want your silver at a discount. Do not give it to them. The execution plan. Weaponize patience. The market is overbought. Don't chase the peak. Wait for the margin shakeout to pull prices back to the 60 to 65 zone. That is where the smart money has set their iceberg orders. Exercise leverage. Silver is high velocity. A 20% intraday swing is normal. Forget 10x leverage. Hold the asset, not the debt. The big picture vision. Ignore the $75 lowball targets from big banks. They are pacifiers. When a structural deficit meets a currency collapse, there is no ceiling. The veil is torn. Silver is the digital crude of the AI era. The whales are in position, and the spring is compressed to its limit. Will you be crushed with the crowd, or will you follow the smart money? The hunt is on. The war is just begun. They want you fixated on gold. They want you dazzled by the record-breaking numbers on tonight's financial news. It is a perfect magic trick. But while the crowd is busy chasing the glitter of gold, down in the vaults of the London and New York exchanges, a real bleed is taking place. Silver isn't just rising in price, it is physically vanishing from the system. This isn't about numbers on paper. The world is running out of the one metal that powers the green economy in the modern war machine. Today, I won't give you empty hype. I'm going to open the macro data files and analyze supply and demand to prove to you why we are facing the decade's largest structural imbalance. Welcome to the Strategy Report. Let's get into the data. To understand why silver is the most important story right now, We need to ignore the short-term noise and look at the big picture. Against a backdrop of escalating geopolitical tensions and global monetary policy uncertainty, the precious metals complex has recorded superior growth. However, there is a distinct divergence. While gold is successively setting new all-time highs due to frantic buying from central banks, silver is quietly forming a much more strategic price setup. My thesis today is clear. Silver is currently irrationally undervalued relative to its fundamentals. Let's start with the first macro factor, the safe haven role. Tensions in the Middle East and Eastern Europe are no longer isolated news events. They have become persistent risks. In this environment, smart money always seeks out hard assets. Although gold is the top choice for sovereigns, silver plays the role of a high beta safe haven. History proves that when gold rises 1%, silver tends to rise 1.5 to 2%. The second macro factor is monetary policy. The market is pricing in the probability that the Federal Reserve will be forced to ease to support the economy. When the tightening cycle ends and the dollar shows signs of weakness, that is the strongest tailwind for silver prices. But that is just the tip of the iceberg. The real story lies in the next section, supply and demand. Unlike gold, where most supply is stored in vaults and recirculated into the market, silver is an industrial metal that is consumed and extinguished. This is the key point that Wall Street often ignores. On the demand side, we are witnessing a shock from the energy transition. Silver demand no longer depends on jewelry or photography like in the last century. The current driver comes from the green economy. The solar industry is booming with next-generation battery technologies like TOPCon and HJT, which require a much higher silver content to achieve optimal conductivity. Add to that electric vehicles and artificial intelligence. You cannot run an AI data center or a guided missile system without high-quality semiconductor components, where silver is an irreplaceable material. But on the other side of the scale, supply is facing serious challenges. Here is a fact few people know. About 80% of global silver supply is merely a byproduct of copper, lead, zinc, and gold. What does this mean? It means silver supply is extremely inelastic. Mining companies cannot simply increase silver production when the silver price rises. They only dig up more silver when the demand for copper or zinc increases. Furthermore, we must address the CapEx crisis, capital expenditure, in the mining sector. For the past decade, under pressure from ESG mandates and low commodity prices, mining companies have drastically underinvested in exploration and development. They have prioritized stock buybacks over digging new holes. Here is the harsh reality. It takes, on average, 10 to 15 years to take a mine from discovery to production. Even if the price of silver doubles tomorrow, new supply cannot come online until the mid-2030s. We are facing a supply cliff that no amount of money can bridge in the short term. The geological reality is colliding with the industrial necessity. Data from the Silver Institute shows the market has experienced a supply-demand deficit for 4 consecutive years. This deficit is gradually eroding the visible stockpiles at COMEX in London. We are draining the final bars out of the vaults. So where is the opportunity? A professional investor doesn't look at price, they look at relative value and market structure anomalies. The East-West arbitrage. There is a critical anomaly occurring right now that demands your attention, the Shanghai premium. While Western markets trade paper silver, futures contracts to set the price, Eastern markets, specifically the Shanghai Gold Exchange, are trading for physical possession. We are seeing silver trade in Shanghai at a premium of 10% or more over the COMEX price in New York. This arbitrage window is a flashing red signal. It tells us that while Western hedge funds are shorting paper contracts, Eastern buyers are draining physical inventory. The smart money in the East is willing to pay significantly more to secure the metal now. This flow of metal from West to East is tightening the physical float to a breaking point. When the COMEX vault runs dry, the paper price will have no choice but to gap up to meet the physical reality. Now, let's look at the gold-silver ratio. Currently, this ratio is hovering around 85. That means it takes 85 ounces of silver to exchange for 1 ounce of gold. Let me give you some context. The average in the 20th century was only about 47. This indicates that silver is absurdly cheap compared to gold. According to the law of mean reversion, if the precious metals market continues its uptrend, silver has an upside potential many times greater than gold to narrow this gap. Regarding market sentiment, the Commitment of Traders report shows that large funds are holding net long positions, but they have not reached extreme levels. This is very positive. It means the market still has plenty of room for new money to enter without fear of being overbought.
However, as responsible investors, we must look at both sides of the coin. What are the risks? The biggest risk is a full-blown economic recession. Since over 50% of silver demand comes from industry, if factories close and manufacturing demand drops, silver prices will face pressure in the short term, unlike gold, which is a pure defensive asset. Additionally, if the Fed maintains higher for longer interest rates to fight inflation, the strength of the dollar will be a headwind hindering price appreciation. To summarize, based on the convergence of macro and micro factors, my strategic view on silver is bullish in the medium to long term. We are standing before a perfect storm. Monetary demand is supported by geopolitical instability. Physical demand is driven by the irreversible green industrial revolution. Meanwhile, supply is constricted by a decade of underinvestment and cannot react quickly. We are witnessing a gradual decoupling between paper silver prices and physical reality, evidenced by the widening Shanghai premium. As stockpiles continue to drop to alarmingly low levels, the pricing mechanism will be forced to reflect the true scarcity of this metal. My advice? Watch the inventory data and the arbitrage spreads closely. Do not let short-term price fluctuations deceive you. When the monetary system shakes, gold is the shield, but silver is the sword. Thank you for watching this report. See you in the next analysis.